This chart shows you the volumes of crude oil and LNG that have flowed via the Strait of Hormuz from Gulf nations in the last 14 months. And concerning liquefied natural gas, you do see that the majority has actually been shipped from Qatar with 195 million cubic meters and only a minority from the UAE. And so you certainly do see that Qatar is the biggest LNG exporter, and because of the hits that Qatar has had in the last few days, we do obviously have major supply disruptions. But those primarily concern European markets and also Asian markets, as we do see that China, India, Europe, and also Taiwan and South Korea do really make up the majority of the importers. The American markets do not really seem to be influenced as much, as we are only seeing the European prices, for example, the Dutch natural gas price and the Asian LNG prices rise significantly. But we haven't really seen that happening here to the Henry Hub spot price, as it has been consolidating at this $3 support for quite some time now. Concerning the technicals, we do obviously have this falling wedge. We do have this consolidation to the downside kind of here. We have recently actually invalidated this $3 support. We're now trading at $2.933. We've also seen a reversal happening here to cumulative volume delta, and so obviously we could see this another breakout here to the upside, at least to the upper band of this falling wedge. Maybe we'll even see a bullish breakout here to those resistances to the upside. But whether this is actually about to happen, we have to take a look at the fundamentals, macroeconomics, and much more to really understand the key drivers that led us here. And so if you like this approach, don't hesitate to hit the like button, subscribe, and also don't hesitate to ask questions in the comments or just give us your opinion. Thanks for your support. Now let's have a look at the weekly chart here at natural gas and some really interesting indicators, because we do in fact see that history is always repeating itself. We do see that those highs at natural gas that basically marked the beginning of massive sell-offs have actually coincided to be bottoms at the gold to oil ratio. In other words, we've seen a divergence occurring before those tops have been built up. We've actually seen that natural gas prices tend to move higher as we're seeing the gold to oil ratio move down. Now, what does that mean? Well, we tend to see oil prices outperform the gold prices before those crashes hit. Now, why is this happening? Well, we tend to see oil shocks. We tend to see that gold prices are weakening. And in fact, you're currently seeing exactly that happening. We are now seeing that this ratio is declining significantly, as we've seen those surges at crude oil prices, and that coinciding to gold prices actually fall. And so that is exactly this divergence that we've historically always seen before those crashes hit, before those tops at natural gas have actually been built up. Now, after those divergences have occurred, we've seen sell-offs happening here to natural gas until we've found a bottom that then actually also coincided to a bottom here at the stochastic RSI. And in fact, we've also seen that those tops at natural gas have been coinciding to tops at the stochastic RSI. And exactly that game plan always actually repeated over and over again. We've seen tops at natural gas, we've seen tops at the stochastic RSI at exactly this 100 mark, which is really showing you where those tops tend to be. And we've seen that play out not only here in 2000 with the dot-com bubble crash, we've seen it happen here in 2003, in 2005, in 2008 with the great financial crisis, and also here in 2014, in 2018, in 2022, and we might just see it happen once again, as we're seeing this divergence where the gold to oil ratio has declined significantly. But we haven't really seen that divergence play out so beautifully, because we've now really had been rather bearish the last few weeks, because we haven't really seen higher prices build out since this high here in March, on the 9th of March. And so we could obviously argue that to really have a divergence forming out beautifully, And as this ratio here is moving to the downside, this would obviously suggest we do see that natural gas might be having another push to the upside. Then this would obviously occur to be a event where we do see those diverge away from the gold to oil ratio, and that divergence would then obviously signal that a crash might be overdue. And in fact, if you have a look at what we're currently seeing happening to the stochastic RSI, you do see that we've already actually topped out twice here on this 100 mark at the stochastic RSI, exactly as it happened in 2021 and in 2022, exactly as it happened in 2019 and 2018 or 2016. And so this is really history repeating once over and over again. We are seeing those tops forming out at the stochastic RSI. We are seeing those tops forming out typically first a lower high and then a higher high, coinciding to two highs at the stochastic RSI. And then we tend to see a divergence where the gold to oil ratio is moving to the downside, as we are seeing those inflationary pressures actually lead to higher oil prices. We do not typically tend to see gold prices surge so much. We tend to see gold prices actually fall or consolidate, and then we do see this ratio falling, and that has historically always led to deep corrections. Now, if you have a look at the daily chart here, you do see that we're in this long-term parallel channel here in blue, and we're still at the bottom of this channel. And so we could obviously argue, as we haven't really seen that divergence play out so beautifully, you could obviously argue that another retest of this upper trend line of this channel might be happening, especially as we're not really seeing this war to end quite soon. We're in fact seeing escalation happening really every single day. And so it obviously could be quite likely we do see some inflationary pressures concerning natural gas regain strength here, that we do see a breakout out of this falling wedge. That obviously would be a quite bullish signal, and we could obviously analyze the market from that point on. But as it stands right now, we are in this technical pattern, which is the falling wedge. We are seeing that we've transitioned to the downside here at this visible range volume profile. And so we're currently in a range where a snap back to those high volume nodes might actually occur, since we do tend to see them act as a magnet. Now we also have to take a look at cumulative volume delta, and so we have to keep in mind that the technicals are certainly not really invalidating anything right now. We could see a breakout happening. That obviously could be a bullish sign. It could also be a fake out. But what might be happening next in the long run, we're quite sure about that. We do believe a crash is overdue. The only question that remains is, are we about to see a smaller spike here, or maybe even a bigger spike to the upside in the short term? And to really answer that question, we have to keep in mind that we really have to see how this falling wedge is playing out. If we do see a breakout, that is quite bullish. We have to keep in mind that there are some resistances that we certainly also have to invalidate for this to really be a structural breakout and a structural long-term bullish trend that might be forming up. But whether this is actually happening, that is what we're about to discuss in the next few videos. So if you don't want to miss them, please don't hesitate to hit the like button, subscribe, and also write us a nice comment down below. Thanks for your support. See you the next time. Bye bye.